Dan, when people point to the U.S. economy, they often say, look at the strength of the U.S. consumer. But are we in a position where actually the reliance of the U.S. economy on the U.S. consumer should start to worry us?
Yeah, I think you put it exactly right. The U.S. economy is standing on one leg right now, and that is the U.S. consumer. Other parts of the economy, whether it's exports, whether it's business investment, those are looking much weaker. So this past retail sales number was a critical number, and it is concerning that despite the reasonable headline number, in all of this sort of key areas of discretion, the consumer's looking like it may be starting to turn over.
Yeah, and Dan, you have a fairly downbeat outlook for next year on the U.S. economy. You describe it as a muddle-through economy facing significant downside risks. Is that an outlook on the premise that the U.S.-China trade war doesn't reach a phase one deal?
No, we actually do see that a phase one deal kind of goes through. However, what we do feel is that the reason why a phase one deal is a likely scenario is that all of the hard stuff has been kicked off to phase two. So we're a lot more concerned about the direction of phase two talks. And once we think investors kind of wake up to the fact that trade policy uncertainty between the U.S. and China is not over, that would weigh upon sentiment again.
Here's a chart. I'm only doing this because Dr. Ahn took logarithms when he was 6 years old. Here's a chart which is very distortive, but it shows the emotion of the change in GDP. This is the Atlanta GDP Now forecast. Somebody, I'm going to give credit to Zero Hedge, I can't remember who, had the listing of the new fourth quarter GDP calls this weekend, and they're all like BNP Paribas-like. But what's so important to me here is the second derivative, which you see in the log, which is the rate of change of this Q4 decline is a big deal. How is a rate of change that sudden matter versus a more gradual rate of change to a 1% statistic?
Yeah, that's a great question, Tom. And actually, we're working on our own version of the nowcasting algorithm.
Come on, let's break some news here. Nobody from BNP Paribas is listening. Break some news here.
Our own models are suggesting that this current quarter, the fourth quarter, is looking pretty weak at around 1% growth.
What is the significance of the second derivative of this economic slowdown? Does the president need to care about that?
So it means that the recent data flow has actually been somewhat concerning, with continued weakness in manufacturing, in business investment, and now in retail sales and consumers as well. So this quarter is turning out, again, looking pretty weak, and everyone should be asking themselves, is the derivative going to turn the other way, and are we going to get upside surprises again, or is this forming a bit of a trend, and the weakness is going to spill over beyond just one quarter and into next year?
So, Dan, will the Fed respond to that with a mid-cycle adjustment or a rate-cutting cycle?
So we actually are expecting another sort of round of insurance cuts into next year, but we'll see sort of what the minutes will say later this week. At the moment, it does look like the Fed is sort of banking or hoping on the economy sort of powering through and the consumer powering through after 1 week quarter, but much is going to hinge upon whether the outlook turns brighter again next year, or whether it continues to show some weakness.
Where's the slowdown? On a partial differential basis, is it a slowdown of consumption? Is it a complete dearth of business investment? Is it export-import dynamics? Which is it?
It's all of the above, but it's really the consumer. We're expecting that business investment and stuff may bottom either this quarter or next quarter, but it's the consumer that, while it remains relatively resilient, does slow down quite a bit.